How you guys doing? I want to do a quick video today on what not to do if things go bad in the stock market. So, as some of you might know, about a month or so ago, I did a video talking about how I was afraid of the stock market in general right now. That hasn't necessarily changed, but doesn't matter. I got that off my chest. I'm not going to talk about that anymore. But what I do want to talk about is one thing that you absolutely should not do if something goes bad, if the stock market starts seeing some ugly days ahead. And that is exactly what happened in 2008, 2009, when there was that huge crash. And I'm going to talk about an example of what did happen at that time, and then you might realize that you do not want to do that. So when I talk about the market and me believing that things are maybe a little bit stressful right now, that doesn't mean that I don't believe in the stock market. And that hasn't changed. I mean, at the end of the day, if you're thinking about the stock market and saying, oh, it's crashing and the economy is failing and all of these things, worst case scenario, well, in order for the stock market to completely fail, that means that every single company in the country, in the United States, has to go out of business. Things have to be so bad that, guess what? Your money doesn't really matter anymore if that happens. It's truly the zombie apocalypse. So what I'm saying is, like, yes, things might get bad, but there are always going to be companies that are going to come out ahead. The stock market will win because people are going to innovate, they're going to try and make things better, and so you are going to be able to recover. If something bad happens, it will eventually get better. But in 2008, 2009, when, for sake of a better term, shit was hitting the fan, everybody got scared, didn't know banks were going out of business, which is crazy. All of these bailouts, all of these other things. Nobody knew what the hell to do, and everybody was scared. Thankfully for me, I wasn't in the industry yet. I was just saving up for the down payment on my first home and realizing that the market dropped like 30 or 40%, and I didn't have as big of a down payment, not even realizing that the advisor at the bank should have had me in a conservative portfolio because he knew that I was taking my money out in a few months. That's beside the point. Now, what a lot of people did at that time is they got really scared and they said, okay, what can we do? We need our money to be safe, so let's go and buy a GIC, and let's buy the best GIC we can get, which at the time would be a 5-year GIC for, say, whatever, let's call it 3%. You're just rocking it out with 3% GIC. And imagine you did this at the absolute worst time. So the very bottom of the market was March 6th to March 9th, 2009. The market was around 6,469. It had dropped 54% since its high in 2007. And people had locked in this GIC for 5 years, couldn't touch the money, were just allowing for that really awesome 3% growth. And then what happened over the next 3 weeks was the market rebounded 20% in the first 3 weeks of the rebound. Just all of a sudden started coming back and said, oh, like this is probably a better level, and just kept going for the next 5 years. Ended up at 16,500 5 years later, 5 years down the road, which in total is 155% return that these people that locked into the GIC missed out on. And that's a 20.6% per year return that they missed out on and locked in at that guaranteed return of 3%. So all they did was guaranteed locked in to missing out on 17% a year worth of growth. And I know that it's scary. And I know that people are thinking you're just entering retirement and you're saying, well, I cannot afford to lose that kind of money. Well, I always think that that's kind of a silly way to look at it, because when people retire at 65 and they have $1 million nest egg, are all of a sudden, are you just taking your $1 million and spending it all at once? Or are you taking, $50,000 a year, for example, and spending it? So you're not actually losing until you pull it out of the market. And most retirements can last 10 to 20 to even 30 years. So you do have that time to recover. I mean, I know that it's terrifying if you see a loss like that, but the market does and will recover. You're not going to, lose out on the idea of saying, well, I can't see a loss early on. If you're that close and that borderline on retirement, then maybe you need to rethink your investment strategy and maybe how you're pulling income out in retirement, because the market will go up and down. And so anyways, I just don't want you to lock in at a loss if something bad happens. If there's a correction, then just don't do that, because you'll be worse off at the end of the day if you do that. So keep that in mind if you're afraid, and we'll get through it. Everybody's in the same boat no matter what happens, so just remember that. And thanks for watching. Please subscribe, and we'll see you soon.